Good afternoon. Ladies and gentlemen, my name is Martin Kölling. I'm the moderator of today, and I will keep my introduction very short. This is Martin Schulz, a fellow German. We won't speak German today, of course, I will promise you. Martin is economist at the Fujitsu Research Institute for years, and many of us know him and value him highly for his insights, not only in economics, but also in the view of companies in Asia. And today he will talk to us about Donald Trump. In the ante room, he wrote in the book basically after and before the Trump shock, and I would like to ask him what he means by that. Please give him a very warm welcome.
Okay. Thank you very much. Well, not starting with that we don't know nothing. This is, as Gerald Curtis already did, and basically anybody else. What economists can usually bring to the table is, well, if not knowing what the next shock will be or the current shock actually is, it is about how systems react. This is what economists doing, looking at a system, economic system, a social system, seeing there is a shock, what is the reaction and the most likely outcome. And this is what I will do. Fortunately for me, I just joined the luncheon to see what Gerald Curtis would say about the political outlook towards Asia. I completely agree with what he has been saying on the politics. It can actually be a positive on Asia, depending on how the situation is playing out. I will put a little bit from the economic side in terms of flesh on the bones for what it would mean for Asia. What I will do is 3 steps. One is looking at the US economy and if a kind of Reaganomics number 2 could actually work. This is more or less the plan, or what we know about the plan of what Mr. Trump is planning to do. So fiscal deficits, industrial policy, infrastructure investment, most likely a strong dollar. How much will that work? I look quite a bit deeper into the economics, so don't run away when I show you some data. Don't run away and call Mr. Trump that these pesky people are running around with too many facts again, and the clear messages will come immediately afterwards always. Asia economy, this is a bit more lofty. This is basically geopolitics, what I think the changes will be on that side. Finally, I don't know why this thing is on there. Okay. Finally, Europe, it's mostly about governance. If there's a vacuum, because the US is leaving the European, in particular the Middle East market and the Middle East war, we have a big governance problem in Europe, which will also affect the economy. I will focus on how important that will be. We have very little in terms of data on that. So let's start it with the market reaction. This is a Bloomberg trend chart, meaning you look at the market, what is changing in the lower end is assets that are trending down as a market reaction, then trending up in the right upper corner. Then you have reversing assets that can be stock markets, exchange rate, interest rates, and so on, and the lower one reversing down. And I compare to get a little bit noise out. 1 year changes, and then the 1 year changes is where you don't have the asset. This is where the starting point of the arrow is, and then the asset where it is now after around 1 month. So after the Trump election from 1 month beforehand, so before the big noise started. So what is basically the change that markets expect from a Trump election? Well, trending down is basically all safe assets. The Canadian dollar, gold, we have the euro there, the yen. Everybody expects that these safe assets are less valuable, meaning the world is safe after Mr. Trump. Well, good to know. Up there, reversing up, we have some stock markets, so we have a positive reaction on the S&P 500. We have the British pound that was trending down beforehand, might get something positive out of a relationship with Mr. Trump. Then copper, a good indicator for China, not much change. It's just sitting there. There is no movement in there. Then many commodities like oil are, well, we simply don't know. Oil down there, copper up there, soybeans in the more right corner. Well, about the world was actually changing, we know very little. We have oil down. This is a reaction on a strong dollar. Of course, a stronger dollar, oil denominated in dollar going down. The Nikkei has been moving up there, which is quite nice. It has been depressed beforehand. And then we have all the interests up there, interest rates up there. The Italian interest rate, the German interest rate, the UK interest rate. That might have a big impact. That is simply, well, the strong dollar plus everybody expects if there is a more expansionary fiscal policy, monetary policy will become tighter. So we might get another Fed shock or a tapering shock with the reaction coming in from the Federal Reserve. This is basically the picture markets are expecting. Now I have to go very long term for a second. These are potential growth rates, long-term growth rates, meaning how much can Mr. Trump actually change in terms of getting the US growing again in the longer run. You see, the US black line has come down after the financial crisis, 2007, 2008, from growth rates around 3.5% to around 1.5%. Long-term forecast until 2030 are around 2.4% potential growth for the US. Mr. Trump wants more. 3, 4, 5%. That seems unlikely from a long-term perspective, in particular when you live in Japan, because we dropped a long time beforehand and we are down there at around, well, 0.8, 1%, something there, and the Eurozone has come down as well. The difference between the major regions is basically demography. People coming into the US, legally or illegally, is 1 percentage point more growth for the US, meaning with less immigration, less work in the US, growth will simply come down to where it is in Germany, in Japan, wherever you look at. That is a big problem for Mr. Trump. Next message. Well, when you have lower growth internationally, when you have to restructure your economies, you get losers as long as growth rates are not really high. When you grow and you restructure, no problem, everybody can win. Plus, you might recover after a while. When you don't grow that much anymore, you get into trouble. And this is the shift from manufacturing and mature economies towards service economies. The services are getting higher valued, in particular in the US, the UK, while manufacturing wages have been depressed. That looks different in Japan and Germany. Japan simply because it regulates services so much that they are not growing very much, at least not outperforming manufacturing. And Germany by globalizing, integrating into the EU, the Euro economy, by expanding its market. So manufacturing were growing as fast as services are doing domestically. Now you see the difficulties are more on the UK and the US side, simply of course because of this imbalance. Losers in the manufacturing, the blue-collar workers. This is a big problem Mr. Trump has to address. And now the worry comes on where the economists are worrying. On the left side, you have price-earning ratios. This is the valuation of stocks. When they're very high, you have to pay a lot for stocks and little yield. And you see, well, there's the 2000 bubble, which was the peak ever. And then compare that. These are really long-term time series. 29, the other global financial crisis. These are the valuations, and we are about that level. So valuations are at peak levels for almost all assets, in particular stocks in this case. The main reason for that is interest rates are so low that you can invest into other assets very easily at very low cost, at zero costs, which means you need very little return on these assets to make them valuable. This will change when interest rates are going up. And this is very important for Mr. Trump and very important what we have seen. Interest rates are already in anticipation are going up. If they go up strongly, stock markets and other asset markets will implode or get a shock, or are being depressed for a long period, depending on how it works out. Then the right one is a very important one that worries economists as well. This is productivity. When economies are not growing because of additional labor input anymore, not because you need more capital, because capital is more efficient, the driver of growth, the remaining one, is innovation, is productivity, is total factor productivity, as we call it. This is the long-term technology addition to the economy. This has never been, or for a very long period, as low as it is now in the US and trending down in most of the other economies. What's very important, labor productivity is coming down almost anywhere now simultaneously, including the emerging countries, including China. So we are all on a negative trend here, which is a very big problem overall when you want to boost growth. Now, in terms of the recovery, what is happening in the US? In terms of the recovery, you see, on the left side, investment, on the right side, profits. And then I stop with all this data stuff. IT equipment, very little shock after the financial crisis, simply because, well, IT is what seems to be, from business perspective, growing the economy. You see that residential, meaning housing, got a huge shock, is basically on track again, but much slower. You see gross investment at a lower level because we had a bubble beforehand. Now, very important and very interesting is actually the transportation sector. These are cars. This is a big chunk of the manufacturing industry. They dropped deeply and then went up again, mostly because, well, global markets expanding on expansionary policy plus a lot of government support. And you also see that in the profits picture. You see durable goods in terms of the profits companies are making are really up there, higher than anybody and higher than during the global expansion beforehand, meaning we do have in this period, over here, already, well, quite stretched markets. If you want to push and boost manufacturing in such a situation, it gets very, very difficult. When we move on monetary policy, and now I'm not killing you with that one, just take in the message. This is monetary policy and it will be very important in defining what Mr. Trump can do and cannot do. M2 is money demand. This is the overall demand in the market. This is the US. This is the EU and Japan. Just take in the differences. These minus excess reserves, this is what the central bank is pushing into the economy, into the banking sector, but not going out, which remains on the balance sheet of banks. So it's not supporting really the economy, just helps the banks a little bit. You see in the US, M2 was growing faster than the trend before the financial crisis. So there has been a huge stimulus. Monetary policy in the US has been tremendously successful. Well, when you look at the EU, you have some financial crisis management. Here, some excess, but not much is actually happening in terms of boosting the overall economy. When you look at Japan, M2 is actually not changing, and all the liquidity Mr. Kuroda is printing remains in the banking sector, has very little impact. This is now quite important when the situation changes. This is the overall interest rate of the Federal Reserve, and this is where it should be in terms of calculations of economists. This is the Taylor rule. You see, actually, interest rates should be much higher than they currently are. And the moment the government is getting more expansionary, the Federal Reserve will follow up, most likely in December. And then perhaps faster than they were planning beforehand, meaning interest rates are going up, and this produces all sorts of different problems. This M2 will come down gradually. The US economy is probably strong enough to deal with that. In the EU, in financial distress, banks will look around and see interest rates rising. That will be a big problem for European banks, in particular in the weak currency. Plus, this liquidity that has been building up and is sitting simply in cash accounts of the banks might be flowing out faster than usual. That means that we see a weaker yen and perhaps quite a bit weaker yen and a huge shift of liquidity into the market from Japanese banking accounts. That would produce a major problem for the Bank of Japan to deal with the situation. So a lot of things Mr. Trump can actually affect. Now I was just adding up a few of the issues by just wrapping them up. Trumponomics, a stronger dollar. This is simply happening before he is actually starting because, well, economists are looking at his plans. This has all sorts of impact. When stronger dollar, imports are going up, exports are going down. You have incoming foreign direct investment because international companies are getting attracted. You might get outflowing foreign direct investment because American companies are expecting a stronger currency longer term, which might support Mexico, Asia, all sorts of moves. You have higher interest rates, which will be a negative for nominal growth, which requires an additional action from the government, which is already planned, deficit spending, tax cuts to make it easier for companies to invest despite higher interest rates, you get additional imports, and so on and so on. You get infrastructure programs, most likely. You get trade restrictions to balance the stronger dollar. which brings in more imports, which is then supporting in many ways the stronger dollar again. So you get a policy here that is getting quite difficult. And then you have the promises of Mr. Trump, in particular when overall prices are going down, prices are going up, you need to see wages are going up, immigration control. That would be a major problem for industry. That would bring prices up further. And you get a policy mix where everybody after a while will ask for more productivity, more deregulation. Well, that would be the Abenomics bit in terms of structural reforms. In the US, it will be as difficult to implement as in any other economy. The US government is mostly stuck. The economy in many ways is stuck. So don't bet on deregulation. The bottom line is, well, we don't actually know how the model will play out. I put a minus on real growth as a, let's say, 3-4 year, one term period, real growth impact. Nominal growth might be positive. These policies can be shaped in a way that it will be positive for growth. And this is what I would expect from a Trump government. How sustainable is a different question. But it would be working as long as there is a lot of deficit spending possible, and as long as the policy can counterbalance a tightening in monetary policy, and the Federal Reserve is not getting too bad. The problem with that is that deficits are already at a rather high level, so the financing will be difficult. Plus, we have a big problem, and this is the final slide of economics. Ignore it, if you want to. This is now growth accounting. This is what we know about the US economy and what we know about in terms of effect. And there are three different periods. One is, well, let's call this the old normal, between 92 and 96, before the IT bubble. Then we have the global expansion, and then we have the bust, 2010, 2014. How's the economy reacting? This is GDP growth, this is capital input, this is labor input, and this is productivity innovation. You don't have to do that if you don't love growth accounting, as I do. But the result is, when you look at it, the contribution to overall growth, you see that in terms of capital, when the economy starts to grow, you didn't actually need much more capital. Capital just became more efficient. In particular, ICT capital has actually gone down during the global expansion. So not much more for a demand for capital. What you see in terms of labor input, relative to what it resulted in, actually it went down. There was 40% of labor input into the economy for production, and during the global expansion only 18%. Now we are 40% again. All the growth basically came from innovation, from doing things smarter, better, by a better combination because of a growing economy. This is a big problem because this ended up not in the pockets of laborers, of wage earners. It ended up in the pockets of investors, of management, and this is where the Trump electorate is upset about. This is an important one. This is the capital share over here. It was in the old 0.3%, 0.7% in terms of what labor gets from all the inputs, and this has changed tremendously. Look at that. It went to 0.38 and now to 4.2. So up here, at a very high level. So capital gets more of the share, while labor proportionally gets less. This is Piketty. Everybody, according to Google, read the first 12 pages. This is really in action. The big question, why is that? Because labor lost negotiation power, or because capital became more efficient and therefore higher valued? It would be a mix. The efficiency story is basically backed up by all the impact that innovation has. Meaning, you grow the economy by increasing the comparatively low investment share right now, and you might get a boost, but that boost will probably end up in innovation again, and then it's redistribution policy. What Mr. Trump is planning in terms of corporate tax cuts, in terms of lowering income taxes, means that the higher share will end up in the pockets of higher income earners if you have this innovation boost in terms of Trumponomics. That is a big problem. He will have to deal with that. That would be redistribution policy. So all this seems to be, well, rather unbalanced in a way. Trump in terms of financing an additional investment boost, is a little bit in trouble. This is Reaganomics. Look at that. In the old days we were discussing during the 80s, is that sustainable, all the deficits? Well, now Bush, Clintons, and so on, and now we are here expanding that. So making foreigners, in particular China, which is saving so much, putting more into investment into a negative current account in the US will be a big problem. Highly questionable how far he can grow with that. Now, the old conviction of the Republicans, if you want to get the economy growing, exports. Because the global market is still growing, it's still comparatively young, this is where you go. This is overall demand in the US, Germany, and Japan. You see, well, in the US, household demand was growing with the economy. We have two investment bubbles having come down. Blowing another investment bubble, well, not very sustainable. What really has been growing in the US as much as in Germany, although the level as a share in the economy is much lower, is really export, is global markets. And this is where Mr. Trump will have to discuss with the House and with his policy advisors where policy is going. It is basically, well, exports, the overall overseas economy that is driving growth at the end of the day. Now, what does all this mean for Asia? This was just the US economy. When we look at what Mr. Trump is planning to do on trade, and usually what happens during a presidency is, well, during the first 6 months to 1 year, you can implement your policies. After that, you're stuck, because policies are getting difficult to discussions on all sorts of things. You get it through two houses and so on. So what you can do as a president at first is trade. This is where initiative can be immediately implemented, and this is what he said he will do. Now look at the US supply chain over here. This is 1990, 2000, and this is 2015. Overall trade is percent of US GDP, and these are the different countries, the top 10. In the old days, Canada, Japan. This is still the old Reaganomics. Japan, big exporter to the US. Now look at that, 2000, that has changed tremendously. Now it's NAFTA being implemented, planned by Reagan, implemented under Bush. Canada, Mexico are the main suppliers to the US. Now China is up here, almost beyond the level of Canada and Mexico. It is part of the supply chain, 4% of GDP. That is a lot. You cannot easily replace it. Plus, very important here, look at Japan. Japan going down, down, down. It is now down there. Where is it? It's in the US economy, and it's in the China supply chain. So the impact on Japan, even if there is a trade war, would be the direct one would be very limited. It would come from the supply chain, which Japan would feel as much as American companies would feel it. So this is a very complex situation that Mr. Trump is really trying to muddle with that. He will renegotiate a little bit. After that, he will most likely being stopped because all this is really too big to fail from a US economy perspective. Now look at the supply chain. It gets a little bit more interesting here. This is the supply. This are China and Korea exports to their main trading partners. China exports in the old days, well, you saw 0.1% GDP as the highest share of exports in as part of the US economy. United States was already up there. The United States is really big up there. So China would definitely be hit. But now look at Korea. In the old days, 2000, biggest share going to the US. That was the biggest market for them. Then China, Japan only following. But now look at that. US basically stagnant in terms of where the exports are going. It really goes into China and from China into the US. Meaning when you mess with the US, with China, even as a US, you will be in trouble with Japan, Korea, basically all the Asian economies around. This is how the supply chains are working. Gerald Curtis was commenting on that. It's clearly visible in the data. Second one, currency war. This is the Chinese renminbi 100 in 2001, and this is an appreciation to the dollar. This is a slight depreciation. The Japanese yen. Asia is dollar zone. But in the dollar zone, the regional key currency was the Japanese yen until the Japanese government didn't want it anymore. It is now moving up and now it is down. It went down, now it's up a little bit again. But overall, Japan made very clear that it doesn't want to be a regional key currency. When you look at Europe, Germany gave up its currency not to be a regional key currency, because it really hits their trade, it really hits the exporters, meaning China was really stepping in as the key currency locally. Very important. If you miss with the renminbi, and it's even in the IMF basket from this year, you are in trouble with Asian currencies overall. When the Chinese renminbi is going down, Asian currencies will go down. Overall, when you look at the big picture in terms of trade, everybody's talking about TPP. TPP, from an economist perspective, is dead from last year. Mostly because, well, the US government was not really implemented it strongly or fast enough, and the Japanese government was comparatively slow. And it is too big anyway. This is a huge trade agreement with many partners. If the US would sign it today, it would take another 3-4 years until it really gets started in Asia. And then implementation would take another 2-3 years. It would take 7-8 years until the first real economic impact would be visible. Now TPP will take at least 10 years, even if they continue to talk about it. TTIP, this is what the EU was planning to do with the US. It's basically dead as well. And this is not just Mr. Trump. These are big trade agreements which are not very flexible anymore, and this is why they're focusing now on quality, which makes them more difficult. While what is happening in Asia is China is creating an Asian investment bank. The Asian economic community in ASEAN is focusing on trade. It is basically flexible agreements. On a bilateral or multilateral level, they try to get some restrictions out of the way in a flexible way, plus focusing on trade more directly. So not so high quality, but more easily to implement. Now, cross out TPP and TTIP, you fall back to an old initiative. This is the APEC, this is TPP, this is the ASEAN group, and this is RCEP. RCEP is ASEAN plus 6. That was an old Japanese idea, actually, and is now championed by China. Simply because China is part of it, because the main Asian powers, including India, are part of it, and it is anchored in the ASEAN group, which made it the core of what it is doing. Plus, look at the economic impacts. This is a general trade model. Look at the economic impact in terms of additional GDP growth over a decade. This is the Americas. They have, of course, impact from TPP, but nothing of the Asian RCEP. This is China, India, and so on and so on. This would be Vietnam with the strongest impact because they have no FTAs yet. You see about 2%, more or less, wherever you go in Asia. That's a huge impact from RCEP in contrast to TPP, which is more or less a political issue getting things going. This is the ASEAN Economic Community, which is not really moving in terms of competition policy, single markets, integration, but it has the RCEP at its core. Reviving that and moving that would have a major impact in terms of overall policies in Asia. It would have a major impact in terms of what is happening for China. This is China trade with ASEAN. Look at that. The imports from ASEAN are already almost flat, while the exports to ASEAN are still increasing tremendously. This is China, the hegemon, that is now growing less at home and needs to invest more overseas. It doesn't expect to be a major investor in the US. It is investing in its markets in Asia, in the ASEAN region, partially in Japan. This is where China is heading. This is where others are afraid of, but might also get some potential positive benefits because China is willing to secure its trade area with its own military on its own costs by building its own islands and so on, as long as these disputes about the regional area can be solved. And interesting, the Philippines are the most problematic together with Vietnam. The Philippines, under the new president, Mr. Duterte, seems to play strongman to strongman and seems to be playing around. Okay, we do security here, we get some benefits here, we do trade together, and we are trying to get Asia integrated from strongman to strongman. That actually is what Professor Curtis meant beforehand. All these strongmen around, Abe might easily fall in place, perhaps not allowing or accepting China in terms of the what is going on in expansion, but in terms of integrating from a trade side and getting some lines where we get along in terms of geopolitics when the US is pulling out. We are done with time. And this means I will look at Europe only in terms of the governance issue, and we can discuss about it, but it's very hard to say what is actually happening, except one thing. Europe is underestimated in many ways, also in terms of what they're doing in terms of governance. The reason is that they are so much underestimated. They have so many crises at their hand. They have the Middle East war resulting in a refugee crisis. They have an almost Cold War situation with Russia-Ukraine crisis. They have Eurozone reform, that they actually have to invite the IMF to help, meaning US support here, even for domestic reforms, and now they have Brexit, which might break up the EU or the Eurozone, which would be a big problem. But they are reacting to that by changing a fair weather governance model. This is EU governance. This is wonderful. Supranational negotiations, institutions, the EU Commission, the Parliament, everybody working together and so on, but highly ineffectual the moment you run into crisis, and this is now the new governance scheme as it's already in place. This is the Council, the head of governments, meeting officially every 3 months, unofficially all the time with a president on top of it. A Eurogroup, it's just the finance ministers, which has the president. There's the Council of Ministers, these are the regions. This is the EU Commission as of the old days and the Parliament. And then you have the president of the central bank taking care of the entire financial system in the meantime. And you have the stability mechanism, which is now reforming banks and going after them. And then the first step of trying to have a foreign and security policy, which is just in place. This new governance concept actually over time could work. The big problem is if they run into trouble, let's say with the Middle East or anything, immediately all these institutions might be overwhelmed and fall apart. This is why they are relying on US support. US support, if this changes to solving the ISIS crisis here, but let's say strong men in the Middle East together again, Trump, Putin, Erdogan together an intervention, they certainly, almost certainly will squish ISIS. That's possible, together with Syria. But the problem is, the big, not only economic but political problem is the confrontation is between Saudi and Iran. You need to solve that one. This is where every government in Europe and the current US government is working on long term. You need to reassure Saudi Arabia that it is safe and has long-term prospects, which is difficult because most of the oil actually sits in Iran and not in Saudi Arabia. And you need to engage Iran because it is really pulling the strings around here. Perhaps wants to integrate into the global economy again. It is not for certain, but this is where everybody's working on. This is where you need the long-term strategies. If the US is going towards intervention here, the Europeans with their weak institutions, like this one down here, is almost certain not to be able to do that. Overall, the situation looks like, well, additional stimulus can actually work. It might blow new bubbles, which seems to be likely if Mr. Trump gets what he wants currently, but that will probably work out, hopefully, in a more sophisticated way. The pivot towards Asia seems to be changing. That might actually support regional integration in Asia, depending on how trade and currency wars with China might be working out. And then the US retreat from EMEA, so not just the EU, would be a really bad idea in the current situation. This is my analysis of the overall situation of Trumponomics so far and what we know about it.
Thank you very much. And it seems everybody's overwhelmed. So after this quick overview, I open the floor to questions, and I hope you have many. So, hands up, please. Anthony.
Anthony Rowley, Singapore Business Times. So what is your net on Asian regional economic integration? Do we get a TPP that's diluted, sufficient to so that everyone can accept it, but is largely meaningless, except sort of symbolic meaning? Or do we get a TPP minus the United States, or do we get some form of RCEP plus the United States, or what? What would be your scenario for this?
Well, in the mature economies, meaning in the EU, Japan, and the US, we really had this trend going from pure trade towards more sophisticated agreements that include courts, IPR, and so on and so on. This has to be negotiated with those countries where the trade is really going on and growing. And that resulted in the WTO falling apart. After that, these other big trade pacts falling apart. In the region where the trade is still growing and trade integration becomes part of your political story and political integration as well, that would be the ASEAN group. It seems to be still working. So my best guess would be a kind of RCEP, so ASEAN +3, ASEAN +6, by being supported by China and Japan. Japan only has to go back to its position of before it joined TPP, which it joined very lately and slowed it down considerably enough so that it wouldn't be implemented. Falling back on that position, doing that with China would be of tremendous interest in ASEAN. So I would guess we get an RCEP, and then let's see what the pluses will be on top of that. How sophisticated it will become is simply regional integration, and then the interests of the partners, China becoming the main investor in Asia. Not the trader, the main investor will be very interested in more high quality agreements that protect foreign direct investment. It would be aligned with Japan on that case. The US would gain on that indirectly and probably following on.
Thanks very much. Very interesting. A lot there, obviously. William Sposato, freelance. On the trade front, trade's already on the decline, right, as a trend, percentage of global GDP. Will you expect, while all this gets worked out, will there be a further decline, and what will the impact, will that possibly trigger a global sort of more of a downturn with other factors coming in, all of it working together in the short term?
It looks like trade restrictions are already going up. Globalization is really under threat. You have bad press wherever you look, except in Asia. So in Asia, trade is growing. It will continue to grow. It will be a bit more imbalanced, and the focus will be on investment. When you look at what is happening in the US and what Mr. Trump is doing, and just the best guesses, look at this incoming FDI and outgoing FDI. You have pluses everywhere. I mean, these are my best guesses. Please take these slides. I made them for you and play with them if you want to. Basically, the focus is on investment, foreign direct investment. You need to look at the bilateral investment treaties. Wherever you go nowadays, it is really a lot of investment. Plus, look at how trade is done nowadays digitally and its services. That is a lot of the stuff. What you're doing in terms of manufacturing, you go into the location, you do this locally. This is why trade is also coming down. When you look at the German slide, which you will also find of what is happening in Europe over here, you find that there is actually not much happening in German exports around there. Even in the EU, although Germany is the biggest trader in the world, simply because they produce their stuff in the locations where they are not trading that much. It is services, it is digital. So this is where the agreements have to go.
Richard Lloyd Parry of The Times. I mean, given what you say, that overall Mr. Trump's ideas are bad ideas for the US in the long term, and assuming he does put them into action, how long is it going to be, and how will it become obvious when that happens? In other words, when are the negative aspects of his policy going to hit home in the US and going to hit the pockets of the people who have supported him? Because presumably in the short term, if he's spending a lot on infrastructure, for example, that is going to produce a boost in jobs, which is what he's promising.
Actually, I don't think that this is really going badly, purely speaking as an economist. I put a minus here, but overall I do expect that with the government coming in and key players coming from the Republican Party, who are traders, who have a strong focus on growth investment, plus wiggle room in terms of, well, that investment is still comparatively low, and there are good targets at low interest rates that will be more profitable than you actually have to pay for, even if you do government investment. I do think that all this can be shaped in a way that it actually has a positive impact. What I'm saying is it won't change the long-term growth of the US economy. So it will still be somewhere around 2.4%. Even if there is a short-term boom in between, I can't tell. This is where economists are really getting so bad at telling the future shocks where it might come from, or where it will really fall apart. Many factors are coming in. This really depends on its immigration and trade policy. I simply don't know. I think it will be shaped in a way that growth will be at about the current level, probably a little bit beyond that, and after that it will simply revert. How big the crisis will be, it will be mostly outside of the US. Higher interest rates usually mean a big problem for financing investment in emerging economies, plus vulnerable economies that would be the EU right now. So at least in a beauty contest where the beauty is in the eye of the beholder, you would probably see bigger troubles from his policies in, let's say, the mid-run in other places than the US directly. That doesn't mean that I'm positive about the policy. I just don't think that it will fall apart or will be a huge problem for the big problem is a little bit like with Abenomics, is you might get it going, you might even get re-elected again, but you don't change the trajectory of your economy, which has been slowing down to a level where many people are unsatisfied, where you cannot really redistribute anymore. So you don't get it to the higher efficiency level. That would really come from focusing on how you implement technologies, how you redistribute between capital and labor, how you shape your education system, your innovation system. And all this is not a bit in the current Trumponomics plans. And this is where long-term growth comes from. But Trumponomics shares that, unfortunately, with a lot of Abenomics, with a lot of what is going on in Britain right now and in many other economies as well. This is my concern.
So I open the floor also to, okay, Anthony.
I just wanted to follow up on your interesting answer to my question. I can see that China will be interested later in a more sophisticated type of RCEP. And as you say, Japan originally put forward a sort of RCEP type of scheme. But there's the US-Japan axis, which and the desire for regional leadership. I mean, are you saying in effect that the US, if the RCEP becomes more sophisticated, the US will come into that? And I mean, there are geopolitical and also strategic considerations as well as trade in this. So, are you saying in effect that the RCEP could become the focus, and that the US and Japan could somehow sort of coexist within this kind of RCEP arrangement?
Well, I've been doing a lot of trade in the very old days, and I'm not doing so much trade anymore. Not only because, well, this is I come from a think tank and a technology company, also because when you look at what really is in terms of how much trade is a driver, the RCEP is clearly still the core of the ASEAN group. And the ACP, it is really crap what you see in many. No, I shouldn't say that, Kamra. So it is really not moving much forward in terms of these high-level and more sophisticated things, like improving competition policy, cross-border. Let's say the aviation system in ASEAN. That would be extremely important. It is not really going in terms of all the labor liberalization, immigration liberalization, and so on. It remains really be trade in Asia. This is where still everybody can agree upon. And then you come in with initiatives that are really linked to the economy and to the region. So Indonesia is becoming is becoming very interested in infrastructure. So you need the infrastructure investors to get things moving, China being there. Thailand was really bad in terms of their IT strategy over 20 years, being late, and gradually they're waking up. Philippines in terms of services. So everybody is waking up on many things where they need to move beyond trade and really get their economy into shape. And there we are seeing alliances, many of them being supported by China in the meantime, most of them tremendously supported by Japan. Look at the Indonesian automobile market, which is linked to the infrastructure. Japan, 95% of cars and trucks in Indonesia are Japanese cars and trucks. Including the Daimler ones, which is Mitsubishi Fuso. This is, of course, this is part of the core of the economy. You link it to infrastructure, which also means that you need to focus on immigration, on IPR, because these are becoming electric over time. Plus, it is really becoming the export hub towards India and most of the markets around there. Tremendous improvement. Thailand, look at the harbor when you just go outside of Bangkok, being the hub of all Asia, including China. I think these are the initiatives are really driving it, not the big agreements anymore. I might be too pessimistic or too optimistic on that, but I'm not really a big fan of these major trade agreements anymore. I might be wrong. If you can get it, it's wonderful not to have a spaghetti bowl anymore and make it easier. But most companies, when they invest, ignore many of the trade regulations anyway. They go after the trade regulations they are facing in the markets, but they don't go after the big agreements. The small companies often do not even use WTO. And the big companies are doing it internally by trading within the company.
Siegfried?
Siegfried Nittel, freelancer from Germany. If debts are rising perhaps in the US and Japan, is it not a problem for the countries? I think the German Bundesbank has a different view on it. And for Japan especially, I think a rising debt with higher interest rates. Is it possible for Japan to finance it? I think people thought Japan will have a problem if interest rates will rise. So what does it mean for Japan?
Well, no. Well, of course, this is a very tricky one. Public debt in Japan has basically been imploding over the last years. This is what Mr. Kuroda is doing. Public debt in private hands, meaning outstanding in the market, where interest rates are being called and earned, is basically disappearing because public debt goes onto the balance sheet of the central bank. It's replaced by money. Meaning it doesn't care any interest anymore. Even the public debt that the Bank of Japan is holding, that still has to pay interest, but it is retransferred every year to the Ministry of Finance from the Bank of Japan every year. So it is zero interest, meaning Japan doesn't have a debt problem anymore. Japan has a money problem because all of that is on the balance sheet of the Bank of Japan is outstanding there in terms of liquidity, and can do funny things when bad things happen. So far, we had a very, very quiet period. Mr. Trump can easily trigger an event in terms of interest rate that would produce shocks, and the Bank of Japan, its new policy is fixing the yield curve, meaning buying at the short, the long end. It would get incredibly busy. Even the election of Mr. Trump meant that the Bank of Japan got, for the first time over years, incredibly busy selling, buying bonds. So this can continue. That would be the main problem. In terms of public debt, not so much. In Europe, yes. Because a lot of the public debt in Europe is owned across borders. And there we are going back to this this is the current account. So debt that is outstanding externally. The problem in the EU is not so much that the EU is indebted, but the EU still sees itself internally as different countries. And Germans do not want to hold Italian and Spanish debt. And they don't want their central bank, the ECB, to own it too. So the solution Japan is going, monetizing public debt, which is working in a way, is not really working in the EU, and that produces the problem when interest rates are going up, that Italy, Spain might easily end up in trouble. The banks are vulnerable in the EU because they haven't really been bailed out so far. So we have a big problem there, not so much in Japan.
And the United States?
Huh? For the United States, it's managed its own fate right now, right? The Federal Reserve can be restrictive, it doesn't have to be. The money outstanding there, and we are going back there, a lot of that is held outside, but in US dollar terms, which is the old wonderful thing the US has. Its deficits are financed by China. So, as long as Mr. Trump not having a currency or trade war with China, that is, at least at first, not really problematic. And as long as the US remains attractive because of expansionary policies internally, foreign direct investment will flow in. That is manageable, at least for quite a while.
Khaldun?
For your insights. My name is Khaldun Ansari, Panorite News. How do you expect energy policy of Trump in the United States? We know the Republican Party reportedly doesn't care so much about the environment. So do you think there will be more digging and more export of gas and oil, especially from Alaska? And how that would affect the oil prices? Thank you.
Well, a president might call NAFTA with a time frame of about 6 months. So if he gives notice on his first day, NAFTA can be history after 6 months. That is possible. He might have other initiatives. Changing the entire energy setup is this category, deregulation. Tremendously difficult wherever you go, often resulting in adverse effects. Even calling the Paris Accord would take 3 to 4 years until it really has an impact. You have to go through both houses with that if you want to change energy policy. Plus, you have to go through all the states in the US. This is not something Mr. Trump, well, he technically cannot do that short term, and probably also not something he's really interested in. He can give support to shale gas, who are coming out of a rock that is being produced by Saudi Arabia. The big impact would probably, a big initiative in the Middle East with ISIS, and heating up Iran, Iraq. So that one, that is your energy policy here, that the US has been playing very, very carefully for a long time, balancing this out with the oil. It is unbalanced now. This is why Saudi Arabia flooded the markets with oil, trying to drown the US shale gas market. This is probably where the prices are really being defined. Whatever you do on coal or anything has a very limited impact. I do expect that Mr. Trump will be negative in terms of CO2, long-term plans, green initiatives. I do expect that he will be positive for many of the utilities in terms of how they are being regulated, but that is a very long-term impact.
Any other questions? You? No? Then one question from my side. I mean, Donald Trump also made a case that China and also Japan are manipulating their currency, but with his policy, it seems everybody agrees that his policies might strengthen the dollar. And with Japan basically keeping the interest rates close to zero, many expect, and also you said the yen might weaken. Wouldn't that cause new frictions on the trade front internationally?
Oh yes. Now, and this is where really, well, the internals of the Trump policy setup are really depending on many, well, not just on many issues, simply the team he's putting together. I mean, he might get one more free trader in there joining hands with the Republicans in the House, would result in a completely different policy setup than, let's say, a Reaganomics extreme tax cutter and following up. Basically, well, it is this trade war, well, even if he on day one pushes further regulation to tell the world that China is a currency manipulator, it is already on the list. You might get tiny changes, but not really big ones, because if China really moves, Asia moves. And China is holding its currency over many, many months already up, well, artificially or stable or comparatively high. If that changes, it's a big risk that nobody in the Ministry of Finance or the Fed would like to take. Plus, in this setup, it is really now the big problem he has to solve, or his team has to solve. I mean, getting manufacturing growing, getting low wage incomes earners, getting higher wages while producing growth at the same time without being too inflationary. I simply don't know how he wants to do that. And I doubt that he knows that. And so far I haven't met many economists who would know how to do that, because it is really, really very difficult and depends on the situation and the trajectory of how you're going forward. Usually, as we know, German in Japan, growth, support exports, manufacturing growth, globalization, for both, get the exchange rate down. This is not what Mr. Trump is doing. If he has that plan, he has to go against the market expectations right now, would really create a big, well, maybe not a slump, but a big problem in terms of explanation, how he is planning to go forward. And then he would need a plan like Mr. Reagan. Mr. Reagan had a comparatively clear plan. Taxes down, and in the situation, restrictive monetary policy because inflation was going through the roof, and he created 2 years of major crisis that had to be settled initially before the economy was gradually coming back on these big tax cuts and with additional industrial policy. For Mr. Trump, it's much easier. Mr. Trump is coming in with a strong dollar. He's coming in with low inflation, with a still supportive monetary policy. So the situation is much, much tamer than what Mr. Reagan had. But he doesn't really have a plan. So it is almost the opposite of what happened in Reaganomics in that time. In my view, what Mr. Trump has at his hands, at least right now, is much easier, and he will probably judge it that way, and just as he often tries to do, is trying not to mess with it. Take the opportunity, move on, see how markets are reacting, moving on. That would be fiscal deficit, expansionary policy, some big item issues in terms of trade that make a lot of noise but little impact, leaving the currency alone. This is what I would expect, but I know as little as anybody of what his team's actual plans are.
Okay, any questions left? I mean, our time is up. And, oh, okay. Can you introduce yourself?
Sorry, Nicholas Smith, CLSA. If Trump gets tight on trade, who the blazes is going to buy his bonds? The two, far and away the biggest holders, neck and neck biggest holders of his bonds are Japan and China, which buy his bonds because they recirculate the trade surpluses they have with it. It seems that you've got a 10-year bond at 2.3% against the 50-year average of 6.5%. Everything seems to be pushing it up, and you've got absolutely massive budget deficits ahead. Sounds to me like the bond market riot has hardly started. So he seems to have a choice between holding the bond market together or honouring his promises on trade.
I agree.
Good quick answer.
No, just see, this is really the difficulties his team will have to deal with. I don't think that they have a clear-cut plan beyond messing not too much. The problem would be, in my personal view, when we have this discussion among economists, would be that you somehow need to keep the Fed on board. That is really, the Fed was already on the way out, which is part of the setup in terms of monetary policy. See, and with an economy so much overstimulated, this is where interest rates should be in terms of, just a general hint of how an economy behaves. They are moving on the way up when the economy is holding together. Anything that smells like a big boost because of fiscal spending or whatever will increase the conviction of the Federal Reserve to move out, which brings interest rates up from both ends of the market. And dealing with that, you can then either start to blame the Federal Reserve or trying to get it on board. He can try a coup d'order, but no, I shouldn't say that here, public. But he could align fiscal policy or his policies with the central bank governor to pull on one string to keep it expansionary as it currently is, plus fiscal policy. This is where the world is moving. Getting out of monetary policy, getting into fiscal policy, but by support of the central bank, yes. But he needs to be a very, very nice player on many levels in Washington to do all that. Let's see. Very difficult.
So we still don't know on which side Mr. Trump will come down, right?
Yeah. Well, overall, I wasn't as negative as as I might be politically, but in terms of economics, he inherits an economy that has been recovering tremendously. He comes out of a period with, in economic policy terms, incredibly smart policy that digested a major financial crisis much better and much faster than all its peers, which is already something. He inherits all that and wants to put something on top of that. It will be very, very difficult in terms of, real economics. So the question would be how he can do that in political terms that look good without messing too much, and then probably adding a little bit here or there. In terms of long-term growth, again, this is in mature economies, technology, something like we do, IT, for example, getting California right and things like that. All this is difficult enough. He doesn't seem to have many plans on this account.
Okay, now I think our time is up. Thank you very much. And it is our custom here, 1 year honorary membership.
Yes, most welcome. Thank you.
And hope to see you soon again. Maybe after the French elections, you can tell us a bit more about Europe.
Oh, we have Italy, we have Holland, we have Germany. So these are really the important geopolitical issues with politics and its impact on it. That will be very, very interesting. Okay.
Thank you.